Looking for what could lift Asia-Pacific stocks this week? A sharp drop in oil may be the spark investors were waiting for. Oil prices slid hard, with Brent settling near $100 a barrel and WTI in the low 90s. That pullback eased inflation jitters on Wall Street and set a constructive tone for the region. Energy is a core input for transport, manufacturing, and many consumer goods. When crude falls several dollars in a day, it can quickly relieve cost pressure and calm guidance from management teams. This matters because markets have been fixated on inflation and interest rates. Lower fuel costs reduce a visible source of price pressure. If that trend holds, it can soften expectations for aggressive rate hikes and improve visibility for earnings. Investors tend to reward clarity, and today's moves hint at better footing for risk assets. Sector dynamics are already shifting. Companies that burn a lot of fuel, like airlines, shippers, autos, and select industrials, often react early to cheaper oil. Consumer discretionary names can also get relief as logistics and input bills lighten. On the other side, energy producers may face near-term revenue headwinds as realized prices drift down. That does not end the energy story, but it changes the near-term balance of winners and laggards. Flows can amplify these rotations. Broad market and sector ETFs adjust quickly as traders rebalance away from inflation hedges and toward growth-sensitive pockets. Earnings estimates usually lag price action, so the first signal is price leadership in fuel-sensitive groups, followed by gradual upgrades to margin and cash flow assumptions if oil stays contained. Keep in mind, oil near $100 is still elevated by historical standards. The move is an easing, not a return to cheap energy. The path from here will depend on supply and demand, policy decisions, and any new macro shocks. That is why investors are watching upcoming inflation prints and corporate guidance for confirmation. Your practical takeaway? Watch Brent around 100 and WTI in the low 90s as signposts for operating costs. Look for improving momentum in transport, select industrials, and consumer names with high fuel exposure and pricing power. Be selective with energy producers until price stability returns. If you prefer ETFs, consider how factor and sector tilts align with a disinflation-friendly tape. Want the full context and data behind these moves? Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.